The stock market looks strong, but it is weak underneath. Prices are near record highs, yet the economy is struggling. Companies show big profits while laying off workers. Consumers carry huge debt, and governments borrow more than they can ever repay. On the surface, everything seems fine, but the reality is different. The system is stretched to the limit. Invisible threads are holding it together, but they are shaking. Every delay in a correction makes the eventual fall worse. Record highs don't mean safety, they mean risk is growing. People feel confident, but that confidence is an illusion. Once it breaks, the system can collapse fast. Think of it like a house built on sand. It looks solid until one strong wave hits. The cracks are hidden, but they are there. The next time the market trembles, it might not recover the same way. It's not about if, but when. And when it falls, it will surprise most people. Smash that subscribe button now to stay ahead of these insights and be prepared for the truth behind the market. Stock prices keep rising, but the real economy isn't growing like it seems. Companies report profits while cutting jobs. Consumers spend more using credit, but their wealth isn't increasing. Governments keep borrowing, creating money that doesn't really exist. The market is fueled by confidence, not real strength. People see numbers going up on screens and assume everything is fine, but it's only an illusion. Growth without real value is temporary. It's like a balloon, big, shiny, but fragile. The more you inflate it, the more likely it is to pop. Ordinary people believe they are part of progress, but the system is mostly designed to enrich the few at the top. The richest investors win both from rising prices and widening inequality. The middle class and everyday people struggle as costs rise faster than income. Real growth is replaced by artificial growth created with borrowed money. That illusion keeps going until confidence breaks. Then, the market collapses and what seemed solid disappears almost instantly. Stocks are worth far more than the companies actually earn. Some of the biggest companies trade at prices that are 60 times their earnings. That's like paying $60 for a $1 meal. During the dot-com bubble, overvaluation led to a 60% crash. Today, the market is even higher compared to the economy. U.S. public companies are valued at over $66 trillion, more than double the GDP. Historical comparisons suggest this should already be collapsing, but somehow the illusion continues. Investors aren't buying value, they're buying belief. They expect someone else will pay more tomorrow. But when reality hits, these high prices cannot hold. Overvaluation makes the fall sharper because more is at stake. Every delay in the crash makes it worse. People ignore the danger because headlines focus on record highs, not the truth. The bigger the bubble, the louder the crash will be. The market keeps rising because money flows freely, not because the economy is strong. Governments borrow, print, and inject money to keep everything moving. This money circulates through companies, consumers, and financial markets, lifting stock prices. It's a loop of artificial prosperity. People spend more, companies earn more, stocks rise, and confidence grows. But this isn't real growth, it's borrowed time. Every dollar printed steals value from those already in circulation. Inflation quietly erodes wealth while the system appears stable. The market depends on confidence, and confidence depends on liquidity. The moment liquidity slows or confidence fades, the system will tremble. Artificial fuel can keep the market alive for years, but it cannot last forever. When it ends, the crash will be violent and fast. Debt is everywhere, in governments, corporations, and households. The U.S. government borrows trillions every year. Companies rely on cheap loans to operate, and consumers max out credit to survive. Everyone is leveraged against a future that may not exist as they imagine. Debt fuels the illusion of growth, but it also creates pressure. When debt can't be repaid, defaults rise, and the system strains. Inflation reduces the real value of debt, but it also erodes wealth quietly. The more the system depends on borrowing, the weaker it becomes. Ordinary people feel the pressure as prices rise, wages stagnate, and savings lose value. The system is addicted to debt, and addiction comes with risk. When debt reaches a tipping point, the market can collapse almost instantly. Banks and large institutions control the flow of money. They issue debt, manage liquidity, and profit from both booms and crashes. During booms, they lend freely and create the illusion of prosperity. When the system strains, they tighten credit and watch weaker players fail. Then, they buy undervalued assets at a discount. The few profit from both rise and fall, while ordinary investors suffer. These insiders understand the risks and prepare before crises. They hedge, buy gold, and move into hard assets. The public is kept in the dark to maintain control. Banks are not gamblers, they are architects of the system. They control belief, liquidity, and timing. Every move is strategic, ensuring the system benefits them even when it collapses. Inflation quietly steals wealth. When prices rise, wages often lag behind. Savings lose value. Assets like stocks may rise, benefiting the rich, but ordinary people pay more for the same goods. Inflation disguises weakness as growth. Companies report higher revenues not because they sell more, but because prices are higher. It's like calling a $1 meal a $2 profit just because you raised the price. The illusion keeps investors calm and markets rising, but ordinary people feel the loss daily. Inflation transfers wealth upward, enriching those who already own assets while the majority struggle. The more the system prints money to delay collapse, the worse this theft becomes. The warning signs are visible if you look carefully. Debt levels are record high. Corporate earnings are slowing. Consumers are maxed out. Stock prices defy logic while the economy shows cracks. Markets no longer move with fundamentals, they move on policy, manipulation, and belief. Small tremors like defaults or weak sectors hint at larger problems. Liquidity is thinning, volatility rising, and insiders are reducing risk. Gold, oil, and hard assets are increasing. Every spark could trigger panic because confidence is fragile. The calm we see now is temporary. Once faith breaks, the market will fall faster than anyone expects. Every major crash follows the same pattern. Euphoria, denial, and sudden collapse. Tulip mania, the dot-com bubble, and the 2008 crash all started with overconfidence and overvaluation. People believe this time is different, ignoring history. The higher the bubble, the faster the fall. The illusion lasts only until belief ends. Central banks and governments delay the inevitable with intervention, but history shows that these measures only postpone collapse. The larger and more connected the system, the more catastrophic the crash. Every cycle leaves the system weaker and more dependent on manipulation. The coming crash won't just affect numbers, it will affect people. Jobs, savings, and retirements are at risk. Ordinary investors will feel the consequences first. The system rewards insiders, not the public. Technology spreads panic faster, making the next collapse unpredictable. Watch the mood, the narratives, and where big money moves: gold, commodities, and hard assets. Faith is breaking, and when it does, everything will follow. The market won't warn you, it will collapse silently until panic spreads. Prepare, learn, and understand the system. Knowledge is your best protection. Subscribe and like to stay informed, and join my free Telegram community to learn how to earn from YouTube like this channel.